Welcome back to Investing Talk Podcast.
Today, we're looking at stock.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When we look at this company, the dominant story right now, the thing that's really driving all the interest, is this massive, and I mean massive, expansion in free cash flow that's on the horizon.
Free cash flow, right. So how big are we talking about here?
We are talking about a projected uplift of approximately $12.5 billion annually.
Wow. $12.5 billion. By when?
By 2026. And that's compared to their 2023 levels.
Okay, that is a staggering number. But, projections can be just that. Projections, is this just marketing optimism, or are there, tangible projects behind this? I mean, where is that cash actually coming from?
That's the core of the whole thesis. It's very tangible. This isn't speculative. It's coming from assets that are, for the most part, already built and are just ramping up. There are really three main drivers. First, you've got just huge upstream volume growth. Think about the Permian Basin, where their output is already topping 1 million barrels of oil equivalent per day.
Hitting 1 million barrels is a huge milestone. But that kind of volume growth takes a lot of capital, right?
Right.
How can they grow FCF so much if they have to keep spending just to keep up?
That's where the other drivers come in. The second one is the ramp up of these massive international projects that are now basically complete.
Ah, so the big spending is already done.
Exactly, like the Tenz's Future Growth Project. The capital has been spent, and now they just get to harvest the cash. And third, you have these high-return barrels coming online from deep water, like the Gulf of America developments, plus the synergies from the Hess deal.
So it's a shift from investing to harvesting.
Precisely. But if volume is going up, you also have to look at the other side of the equation, costs.
Right. Are they being disciplined on that front, too?
Absolutely. That's the second pillar here, a really structural focus on cost reduction. They're targeting $3 to $4 billion in operational savings by 2026.
And these are permanent cuts, not just a one-time squeeze.
That's the idea, structural efficiencies. So every single barrel they produce going forward just carries a higher cash margin.
So you combine that volume growth with the cost cuts.
Yeah.
And you get a compounding effect, which I guess leads to what everyone calls their fortress balance sheet. But what does that actually mean in practice?
Well, the proof is right there in the numbers. Look at their debt. Their net debt is way below historical norms. But the real discipline, I think, is in their capital spending. They've explicitly capped their annual capex at $18 to $21 billion all the way through 2030.
Capping spending like that. Doesn't that risk stagnation?
Well,
how do you grow with a cap?
Because the big projects driving that cash flow, Tenges, the Permian, Hess, they're mostly funded or already hitting peak output. That cap is a signal. It says future growth won't come at the expense of shareholder returns.
Okay, so it's a safety net.
It's the ultimate safety net. Their FCF is strong enough to cover their dividend, even if Brent crude drops below $50 a barrel.
And that changes everything for a long-term investor. That's real security.
Exactly. And that financial strength allows them to commit to huge returns. We're talking $10 to $20 billion in annual share buybacks.
Which retires, 3 to 6% of their shares every year?
Every single year. And that's on top of the dividend, which is yielding around 4.5% right now, with 38 straight years of increases.
Okay, so a financial fortress built on cash from these big maturing projects makes sense. But let's talk about the assets themselves. I mean, how do they stack up against their peers? What's their competitive moat?
It really comes down to the quality and integration of their portfolio. It's all about high-margin barrels. They have this great mix. You've got the short-cycle, flexible shale in the Permian, which they think could eventually top 2 million barrels a day.
That's the quick turnaround cash. But what about the long-term, stable assets?
That's where they balance it out. They have deep water leverage in places like the Gulf of Mexico and now Guyana, thanks to the Hess deal. Plus, you have the global LNG optionality from their big Australian projects, Gorgon and Wheatstone. It's a really resilient mix.
You mentioned high margins, and there was a fascinating point about their sensitivity to price versus volume. Can you break that down?
Yes, this is key. The company is basically set up to capture massive upside with very little extra effort. Their earnings, well, they aren't that sensitive to small changes in production volume. It takes a huge effort to move that needle. But their earnings are incredibly sensitive to the price of crude oil.
Give us a number on that. How sensitive?
It's about a $550 million change in after-tax earnings for every $1 move in the price of Brent crude.
Wow. $550 million for every dollar.
Yep. So if they don't have to chase expensive new projects just to keep volume flat,
Then any price increase just flows straight to the bottom line. The marginal barrel becomes pure profit.
exactly. It drives EPS and FCF upside way faster than volume growth ever could.
Okay, that positioning is really compelling. Let's shift gears a bit to something unique, the Venezuela factor. For years, this was just seen as a massive political risk, but now it seems to be turning into a real advantage for
Yeah,
them.
it's probably their single biggest differentiator right now. Stock is the only major U.S. oil company with a real active presence in Venezuela. 5
The
projects.
first mover advantage if things open up.
A huge one. They're perfectly positioned if sanctions continue to ease.
But getting the oil out is only half the battle. I understand the real advantage is in their U.S. refining capabilities, right?
Well, this is their secret weapon.
Hmm.
It's not just that they can process heavy crude, it's that most of their peers retooled their Gulf Coast refineries years ago for lighter crude. SOC didn't. They own these sophisticated refineries, like the one in Pascagoula, that are specifically configured for heavy, sour Venezuelan grades.
So they control the entire value chain. They produce the exact type of crude their own refineries are built to handle.
Correct. It's a closed loop, an end-to-end, highly integrated system. If they can export more from Venezuela, they capture the margin on production and the margin on refining. It's a huge structural advantage.
So what are the catalysts to watch for here? Is that door opening any wider?
It seems to be. They're in ongoing talks with the U.S. government to broaden their license. Any regulatory change there is a direct, immediate catalyst for the stock.
And what about this market buzz about a bid for Lukoil's assets?
Right, that potential $22 billion bid, it just reinforces their position.
Because they have the financial firepower to do a deal that big.
They have the firepower and the strategic reason to do it. It's a cheaper way to add reserves and scale than building from scratch. It positions them as a consolidator in the industry. Now let's pivot to the technical signals. The fundamentals look strong, but we need to see what the market is actually doing with the stock.
And the technicals really seem to confirm that institutional conviction. The stock had a strong start to the year, climbing to around 155. But the real confirmation of the uptrend was that recent breakout around 164.75, and it happened on huge volume.
Yeah, nearly 24 million shares. Volume is so important. That level of volume tells you it's institutional money driving the move, not just retail hype.
And the momentum indicators.
The MACD is firmly positive, so the trend is clearly up. But, and this is interesting, we have to look at the RSI for balance.
And what's that telling us?
Well, the 14-day RSI is hovering near 76.
Which is technically overbought territory.
It is. Now, that's not a sell signal, but it suggests the market might need to, pause and digest all this good news.
So for a new investor, this might mean the stock is a bit overheated right now.
It could. It suggests that instead of another vertical move, we might see some sideways consolidation, maybe even a slight pullback.
Yep.
And that could actually offer a much more attractive entry point near some of the support levels.
So what are the key levels you're watching?
Okay, near-term support is right around 151. As long as it holds that, the uptrend is intact. Resistance is near the current price, around 156, and then, of course, that big breakout zone near 165. A strong move past that would signal the next major leg up.
All right, let's talk about the other side of the coin, the risks. Because no investment is a sure thing.
And the most obvious risk, as always in this sector, is the price of commodities.
We've already heard warnings from competitors about Q4 earnings being hit by lower prices. If Brent stays stuck below $70, that $12.5 billion FCF growth story gets a lot harder to achieve.
For sure. And then there's Venezuela. It's the ultimate geopolitical wild card. The upside is huge, but the risk is just as big. The infrastructure there is, well, it's severely eroded. It would take years and billions of dollars to get back to historical production levels.
And that's all layered on top of the sovereign risk. Unresolved debts, political instability, it could turn into a very expensive distraction. So how does the company mitigate those huge macro risks?
Primarily through diversification and that financial discipline we talked about. And this is crucial. That $12.5 billion in FCF growth is not dependent on Venezuela. The main drivers are all internal. The Permian, Tengiz, the Hess deal. Venezuela is basically pure upside optionality.
So the core investment case holds up even if Venezuela goes south.
Exactly. And that low-cost asset base, that disciplined spending, it gives them a buffer. They're resilient down to that $50 Brent price point. That's their protection.
Finally, let's look ahead. What's on the catalyst calendar? What should we be watching for the next few weeks?
The big one is Q4 earnings, which should be around January 30th. Investors will be watching for three things. One, volume guidance for the year. Two, any hard numbers on their cost control progress. And three, any official updates on the Venezuelan license or the pace of their share buybacks.
And on the macro front?
The next OPEC Plus meeting is always a factor, but the consensus is they'll probably hold their targets. That should support a stable price. Beyond that, it's just keeping an eye on those U.S. policy discussions around Venezuela. That will continue to be a source of headlines. So if you put it all together, the visible, internally generated cash flow growth paired with that unique, differentiated upside from Venezuela, it really does make for a compelling multi-year total return story. It's about a company shifting from a big spender to a cash machine.
A very comprehensive look, from the Permian targets all the way to those RSI readings. Thanks for walking us through it.
My pleasure.
And to you, the listener, make sure you subscribe so you don't miss our next analysis.